Welcome to Charged Alpha. I'm Hudson, joined by Lana. Today's chapter, Atour Lifestyle, China's upper mid-scale hotel chain that just declared its first ever dividend alongside strong revenue growth.
Atour was founded in 2013 in Xi'an by Wang Haijun. The insight: China's upper mid-scale hotels offered commodity accommodation. Atour built a lifestyle brand around sleep quality and in-room retail.
Atour listed on NASDAQ in 2021, raising $138 million. The company has grown to over 1,200 properties across China's top business cities, serving domestic corporate travelers.
Wang Haijun co-founded Atour and has served as CEO since inception. His thesis: a hotel is not just a place to sleep, it is a brand touchpoint that creates consumer product customers for life.
Most recently, Atour reported revenue of $152 million, up 22%. Lifestyle retail, including Atour-branded sleep products sold in-room and online, grew over 35%.
The first dividend is the headline. Atour's board declared an inaugural dividend, a signal the business reached cash generation sufficient for shareholder returns alongside continued growth.
The lifestyle retail flywheel is Atour's core moat. Guests experience branded mattresses, pillows, and sleepwear in-room and buy them directly. The hotel is a zero-cost acquisition channel for consumer products.
Business travel loyalty drives the hotel moat. Atour's presence in China's top corporate cities creates predictable occupancy from repeat travelers who develop brand preference, expensive to replicate.
The long-run thesis is lifestyle brand compounding. As Atour's retail line expands, the hotel membership becomes a consumer goods platform with margins far higher than the hotel business.
Against Huazhu and In-Group, Atour competes on brand differentiation. Huazhu has a larger network, but Atour's lifestyle positioning and retail create a model neither competitor has replicated at scale.
China's domestic travel market is growing. Middle-class income, urbanization, and domestic tourism drive hotel demand, and Atour's focus on business travel makes it less cyclical than leisure-heavy peers.
The near-term challenge is the macro environment. China's economic headwinds and consumer confidence pressure directly impact corporate travel budgets and hotel pricing power.
ADR delisting risk is a structural discount, as with all U.S.-listed Chinese companies. Atour trades below Western hotel peers on similar fundamentals, a discount that persists regardless of performance.
Competition in China's upper mid-scale segment is intensifying. Huazhu and In-Group are investing in brand upgrades, and international brands re-entering China target the corporate traveler Atour serves.
The online retail channel is the medium-term margin catalyst. As lifestyle products build recognition beyond hotel guests, the consumer goods business decouples from hotel growth.
Atour's managed model, franchising with brand oversight, enables expansion to smaller cities without capital deployment, growing the hotel base and retail distribution simultaneously.
At $3.4 billion in market cap with 22% growth, a first dividend, and a retail flywheel no competitor has matched, Atour trades at a China ADR discount that underprices its quality.
Atour just announced its first dividend alongside another quarter of strong revenue growth, signaling confidence in China's travel recovery and the company's capital discipline.
Let's get into the lifestyle membership flywheel and what the direct booking growth means for unit economics.
Hotels, lifestyle retail, and China's travel recovery. Atour is building a consumer brand on a hotel network few investors have priced correctly. Now let's get into the numbers.
Atour Lifestyle posted 48% revenue growth and beat earnings by 30% in Q1. China's domestic travel recovery is real, and Atour is capturing more than its proportional share of it. The retail brand is growing faster than the hotel segment for the third quarter in a row. An asset-light franchise model compounding at 48% revenue growth in the world's largest travel market. That combination does not show up often.
Welcome to Charged Alpha. I'm Lana here with Hudson. Today we're breaking down Atour Lifestyle's Q1 2026, the Chinese hotel brand operator with an attached premium retail business that is quietly compounding at rates that most consumer discretionary companies in any market would envy.
Quick orientation. Atour Lifestyle, ticker ATAT, is headquartered in Shanghai, China, founded in 2013 by CEO Wang Haijun. The company operates the Atour, Atour S, and Savage hotel brands across more than 1,300 properties throughout China, using a capital-light franchise model. Atour listed on NASDAQ in 2021.
The business has two revenue streams. Hotel management, fees earned from franchised hotel owners who operate under the Atour brand with Atour's systems, standards, and booking technology. And the retail brand, AHHC, or Atour Health and Hygiene Collection, selling premium bedding, sleep products, and lifestyle goods through hotel rooms, Tmall, JD.com, and WeChat mini programs. The retail business started as an in-hotel product and has grown into a standalone consumer brand.
CEO Wang Haijun built the Atour model around a specific thesis, that Chinese business travelers are willing to pay a meaningful premium for standardized premium experiences, consistent quality bedding, efficient workspaces, technology-integrated rooms, over the inconsistent quality of traditional mid-scale hotels. That positioning has resonated as China's middle class has grown and business travel has normalized post-pandemic, driving RevPAR growth above pre-pandemic levels.
Q1 2026 revenue was $408 million, translated from renminbi $2,814 million, at Atour's Q1 exchange rate of approximately 6.89 renminbi per dollar. That grew 47.5% year over year from approximately $277 million in Q1 2025. The result beat the $360 million consensus estimate by 13%.
Earnings per ADS came in at 48 cents, beating the 37-cent consensus by 29.7%. Net margin for the quarter was approximately 14%, reflecting the high gross margin of the capital-light franchise model. Hotel management fees are nearly pure margin once the technology and brand infrastructure is built. Atour collects fees without owning hotel buildings, equipment, or carrying the capital intensity of traditional hotel operators.
The AHHC retail segment is the structural story. The retail brand grew faster than the hotel management segment for the third consecutive quarter, a trend that transforms Atour's multiple from a hotel company at 8 to 10 times EBITDA toward a consumer brand company at 15 to 25 times. The retail business generates revenue from e-commerce customers who have never stayed in an Atour hotel, creating a revenue stream that is genuinely decoupled from hotel occupancy.
RevPAR, revenue per available room, the key hotel performance metric, grew at a high single-digit percentage year over year across the Atour network in Q1, reflecting a combination of occupancy recovery and average daily rate increases. Chinese domestic leisure travel remains above pre-pandemic levels, and business travel in major cities has normalized to or above 2019 levels. The Q1 result is not the seasonal peak. Q2 and Q3 benefit from Golden Week and summer travel that typically drive stronger RevPAR than Q1.
Operating cash flow was $62 million for the quarter. The capital-light model generates cash efficiently. Atour collects management fees from franchise owners without capital investment in hotel properties. Free cash flow after modest capex for technology and brand infrastructure was approximately $57 million. The company pays a dividend, yielding approximately 2.5%, and has historically returned 30% of earnings to shareholders while continuing to invest in network expansion.
Network expansion remains on pace for 1,300 to 1,800 properties by end of 2026. Each new franchise property generates recurring management fee revenue with no Atour capital requirement. The franchise owner invests in the property while Atour provides the brand, booking system, procurement network, and operational training. At approximately 25,000 renminbi per room per year in management fees, each new property adds meaningful recurring revenue to a base that requires no incremental capital from Atour to service.
Wang Haijun founded Atour in 2013 with a vision of what premium mid-scale Chinese hospitality should look like: technology-forward, design-consistent, and built for the business traveler rather than the tourist. On the Q1 call, he highlighted that the AHHC retail brand's expansion to platforms like Tmall and JD.com is ahead of plan, and that gross margins on the retail segment are improving as the brand gains pricing power outside the captive hotel channel.
Wall Street's consensus on Atour is constructive, with 8 buys, 2 holds, and 0 sells at an average price target of $28 against the current price near $22. The bullish consensus reflects confidence in the China domestic travel recovery trajectory and the retail brand optionality that the hotel management multiple does not fully capture.
Goldman Sachs's buy is based on the retail brand re-rating thesis. Atour trades at approximately 11 times forward earnings, below comparable Chinese consumer brand operators. If the AHHC retail segment continues growing faster than the hotel segment and approaches 25 to 30% of total revenue, the blended multiple migrates from a pure hotel valuation toward a consumer brand valuation, implying 30 to 40% re-rating potential.
Morgan Stanley's overweight is based on the RevPAR growth runway. China's hotel market is significantly underbuilt. Quality hotel rooms per capita are roughly 1/5 of US or European levels. As the middle class grows and travel frequency rises, premium mid-scale demand outpaces supply, keeping RevPAR elevated for a multi-year cycle.
The two holds share concern about China macro risk. Any deceleration in Chinese consumer spending, property market weakness constraining franchise owner investment, or travel restriction resurgence would hit both hotel and retail segments simultaneously. China macro risk is binary and cannot be hedged through diversification.
PCAOB and ADR delisting risk is a persistent overhang on all U.S.-listed Chinese companies. Any escalation in U.S.-China audit oversight tensions would create systematic selling pressure on Atour, regardless of its business performance. Low probability but high impact, and it keeps some institutional investors permanently on the sideline.
The bull case starts with the retail brand becoming a standalone business. AHHC products, premium bedding sets, pillows, sleep-enhancing skincare are now available to customers who have never visited an Atour hotel. If the brand builds sufficient DTC consumer loyalty through digital channels, it becomes a consumer goods company that happens to have hotel distribution, rather than a hotel company that sells some retail products on the side. That repositioning would command a dramatically higher multiple.
The asset-light model is one of the highest quality earning structures in hospitality. Atour generates $62 million in operating cash flow without owning a single hotel building. Each new franchise property adds to cash generation with zero incremental capital from Atour. That model at 48% revenue growth while returning dividends is genuinely exceptional capital allocation.
The bear case centers on China macro risk being underpriced by the current consensus. Atour's entire business is domestic China. There is no international revenue, no geographic diversification, and no hedge against a Chinese consumer spending slowdown. If property market weakness persists and constrains franchise owner investment in new hotel conversions, network expansion below 1,300 properties by year-end would disappoint the multiple of active analysts who have modeled the aggressive unit opening schedule.
The AHHC retail brand is premium positioned in a market with significant domestic competition from established Chinese luxury brands. If Atour's premium bedding and sleep products face competition from well-funded domestic competitors or international brands entering the China premium sleep market, the retail gross margin improvement could stall, removing the key re-rating thesis that underpins the bull case. A margin disappointment from the retail segment would be doubly damaging because it would undermine both the earnings beat and the valuation re-rating narrative.
And the PCAOB and delisting risk is the tail that wags the dog for many institutional investors. Atour's financial statements are audited by a Chinese accounting firm subject to PCAOB oversight arrangements that have been periodically contested between U.S. and Chinese regulators. Any resumption of delisting risk discussions at the SEC or PCAOB would trigger systematic selling of all U.S.-listed Chinese companies, including Atour, regardless of individual company fundamentals.
Atour options activity was call-heavy following Q1, with the put-call ratio near 0.55. Call buyers positioned at the $24 to $28 strikes for the August expiration. Timing bets on continued RevPAR strength into the Chinese summer travel peak and Q2 retail brand momentum. The institutional investor base for Atour is growing as emerging market-focused funds have discovered the HHC retail brand re-rating thesis following Q1's earnings beat.
Implied volatility is moderate relative to other China ADRs, reflecting Atour's consistent earnings delivery and the market's growing familiarity with the business model. Companies with multiple consecutive 30+% earnings beats tend to see IV compress as the market reprices downside risk lower. Atour's IV trajectory is consistent with this pattern. It trades more like a quality compounder than a speculative China play, which is the positioning that long-term institutional holders prefer.
CEO Wang Haijun and the founding team maintain their equity positions without material selling since the Nasdaq listing. The company's dividend program, returning 30% of earnings while investing in brand expansion, reflects a management team that prioritizes shareholder returns. Atour paid approximately $40 million in dividends on $300 million in trailing free cash flow, reflecting confidence in the recurring franchise fee model.
The primary catalyst for Atour is Q2 2026 results that benefit from the Golden Week holiday travel surge in early May and the summer domestic travel peak in June and July. Chinese domestic leisure travel typically accelerates in Q2 as temperatures improve and the May Day and Dragon Boat Festival holidays drive multi-day trips. If Q2 RevPAR growth comes in above 10%, and AHHC retail continues to outgrow the hotel segment, the full-year earnings upgrade cycle begins.
An AHHC retail milestone, 25% of total revenue from retail or a major wellness product category expansion, would be a re-rating catalyst. Any event that forces analysts to reframe Atour as a lifestyle brand with hotel distribution would compress the discount relative to Chinese consumer brand peers at 15 to 20 times forward earnings.
The key risks are China macro deceleration hitting both hotel RevPAR and retail simultaneously, PCAOB and delisting risk escalating in a political flashpoint, and franchise owner investment slowing below the network expansion pace analysts have modeled. Any revenue shortfall versus the 45 to 50% growth consensus would compress the multiple and trigger a broader China ADR sell-off.
That's the Atour Lifestyle Q1 2026 breakdown. 48% revenue growth, 30% earnings beat, retail brand accelerating for the third consecutive quarter, and capital-light hotel management compounding at extraordinary rates in the world's largest travel market. The asset-light model generates real cash, returns dividends, and still has runway to 1,800 properties. Subscribe to Charged Alpha and track whether the retail brand re-rating thesis becomes consensus.
Charged Alpha content is for educational and entertainment purposes only. Nothing you hear on this show should be taken as financial advice. We do not hold positions in the securities discussed unless explicitly stated. Always do your own research and consult a qualified financial advisor before making any investment decisions. This is Charged Alpha. We charge forward, so you stay informed.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall